The Bank of Canada may have held the overnight rate steady, however, they did increase the neutral rate. What's the neutral rate? Well, it has a lot to do with the expectation of where interest rates are going to go in the future. And that could mean higher interest rates for longer. But before I get into all the details, my name's Nolan Matthias, and if you want the latest Canadian financial and real estate news, this is the place for you. So hit the subscribe button and hit the like button so more people like you can see this video. And if you're looking down and you're going, hey, I thought I subscribed to Nolan already, and you're seeing that you're not actually subscribed, that's because you're probably subscribed to my other channel, the bigger channel that focuses on more general and global wealth topics. So make sure you subscribe to this one too if you want the Canadian info. Okay, so the Bank of Canada, obviously they didn't increase interest rates at the last meeting. However, they did increase the neutral rate. Now, this was not included in the interest rate announcement, but it was included in the Q2 monetary policy report. And while this may not have seemed like big news, it actually is, because it has to do with the expectations of where interest rates are going to go in the future. And when they raise the expected neutral rate, that typically means that they aren't expecting interest rates to go down as much as they originally anticipated. And I'll get to that in a little bit in the end when I talk about the exact changes with respect to the neutral rate and how that can affect you. But what is the neutral rate? The neutral rate is a band of interest rates where the Bank of Canada, or a central bank for that matter, is expecting that that interest rate wouldn't have a negative or a positive effect on the economy. So in other words, it is the rate where inflation is not growing and it's also not decreasing. And central banks use this range of interest rates to help sort of determine where they think the right place for interest rates is to be. And even though this wasn't a main piece of the news release, and it wasn't something that was widely watched, it did have an impact on bond markets, which of course affect mortgage rates. And it also had an impact on where interest rates are expected to go in the next couple of months. And I want to start by showing you the Bank of Canada government bond yield, because this went up about 15 basis points yesterday, which is the equivalent of 0.15%. And the reason why is because of the shift in the neutral rate expectations. And typically when we look at this Canada 5-year government bond yield, this is what the 5-year fixed mortgages are being priced off of. So we could, in theory at least, see 5-year fixed rates start to trend up. However, that being said, there is a significant amount of margin that the banks have been playing with in the last couple of months. And we have been seeing that these banks and most of the lenders are getting more competitive. So there's also a chance that there isn't going to be increases to those 5-year fixed rates, but it's something to watch. But it's also, of course, not the only thing to watch. I want to jump in here and I want to show you the Bank of Canada release, because there's some interesting stuff in here and I'm going to go through the highlights. Now, to start with, there was a lot of discussion in this release about the global economy. The fact that the global economy is growing at about 3% right now. The fact that the US economy is growing much faster than expected, although it is expected to slow in the second half of the year, which is important to Canada, because if it doesn't start to slow, well, that could create a scenario where the Canadian economy is going down, the US economy is going up, and we have to cut interest rates while they don't, which has an impact on our dollar, which has a whole bunch of other problems associated with inflation and all of that stuff. And then they highlight that in Canada, and this is in contrast, of course, to the US, economic growth has stalled in the second half of last year as we move into excess supply. So in other words, there is less demand than there is supply for goods. And we're seeing that in a lot of things with respect to pricing, especially in the food markets, especially in places where over the last couple of years, inflation has been very high and it is now substantially less than what it was. Then they get into the bank's GDP growth forecast. So basically looking at in 2024, growth to be about 1.5%, which is probably lower than where they want it, 2.2% in 2025, 1.9% in 2026. And obviously, they're expecting the economy to strengthen gradually, especially as they start their rate lowering process. And obviously, they talk about inflation, the fact that it has slowed, but they aren't quite sure yet whether or not it has slowed enough to warrant the rate cuts. And more specifically, what they're saying is that they want to see further evidence that the inflation coming down isn't just temporary, but it is actually down and it is going to stay down before they start cutting interest rates. And this got really interesting with respect to the expectations on where interest rates are going to be heading into the June and July Bank of Canada meetings. And essentially where the market is at right now, and if you look at this, this is what's called the CDOR forward curves. Well, what this shows, and this isn't up to date yet, there's also a better set of numbers, a better set of data that now predicts this with respect to credit swaps. and with respect to the market bets on where interest rates will go. But basically what you can see is leading into this most recent meeting. This was done on April 1st. Obviously, that's before this most recent meeting. They were pricing in about a 50-50 chance of interest rates going down in June. The way that you can determine that is if you look at the 1 month and the 3 month rates, they're about 5.17, which is less than the Bank of Canada overnight rate of 5.25%, but higher than what it would be if they were to drop a quarter point. So this tells us that there's about a 50-50 bet that interest rates could come down in June. And then if you look at July, prior to this meeting, it was at about 5.11%, which is about a 60% chance that interest rates are probably going to come down. And then if you look into the August numbers, that was pretty much priced in full that there would be a interest rate decrease in August. Now, all that being said, these numbers have changed over the last couple of days, and now the market is pricing in fully an interest rate decrease in the July meeting. So 50-50 in June, and almost 100% chance of interest rates coming down in July. At least that's what the market is seeing. Now, I have to have a caveat on that because that is a forecast. And forecasts, as you know, aren't always true, and they can change on a daily basis. So don't go and think, oh, interest rates are definitely going to come down in July, because they might not. But right now, based on the data that we have, that is what the market is suggesting. Now, I want to show you this thing about the neutral rate. I want to come back to this. So if you take a look at, this is the monetary policy report, and you take a look at this section right here. The nominal neutral interest rate in Canada is estimated to be in the range of 2.25% to 3.25%, up 25 basis points from the January report. The economic projection assumes that the neutral rate is in the midpoint of this range. Details about the bank's annual assessment are provided in the appendix. Now, I'm going to spare you the details about the bank's annual assessment. However, what this means is that at the high side, the bank expects the neutral rate to be 3.25%. This is up 0.25% from what it was in the January report. Now, this doesn't mean that over the next year or two, when 60% of mortgages are going to renew, that this is going to be where it stays. Because over time, we could very well see the neutral rate continue to increase as we get more and more data. So what this means for people who are taking mortgages is that 5-year fix that is still substantially cheaper than what a variable rate mortgage is still a pretty safe bet. Although you have to be very careful. Do not get this from a B lender. And what do I mean by a B lender? If you've been watching this channel for some time, you know that a bank stands for B lender. B is for bank. Because the banks have higher penalties, which means if interest rates do come down, you won't be in a position where you can pay your penalty, refinance to a lower interest rate, and benefit from any rate cuts that are coming. So don't make the mistake of getting a 5-year fixed mortgage right now from a B lender, from a bank. Just don't do that. It's 2024. Go to a broker. Make sure you check out all of your options and you understand the mortgage that you're getting, and understand that there are significantly better lenders out there, because these lenders have to be better lenders, because if they weren't, they wouldn't be able to compete with the big banks who can skate on their marketing budgets and their reputations and screw you by charging you basically a significantly higher penalty than what the going market rate is. Oh, and all that stuff about, hey, you're a client, you're going to save this much money over time by being with us. Well, they never factor in the penalty into any of those calculations, and they know that most Canadians aren't going to make it to the end of their 5-year term. They make a ton of money off of payout penalties, which is basically free money for them and not money that they factor into the calculations when they say, hey, you're this much better off when you deal with us as a B lender for your mortgage. So yes, while the Bank of Canada didn't decrease interest rates, they did increase that neutral rate, which means there is a significant change in their expectations. And if you want to see more on some crazy things happening in the Canadian real estate world, especially with respect to Justin Trudeau and what he's proposing in the latest budget, make sure you check out this video right here.